Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how high mortgage rates could go, as well as existing home sales and inventory.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to housingwire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
Logan, welcome back to the podcast.
Holy Toledo, Sarah Wheeler.
This
It is just a crazy week.
This is a crazy week. Okay, so unfortunately, I feel like I have to start out this podcast by asking you about 8% mortgage rates. Like, what is going on?
Yes. The Fred presser, it's really interesting because we were talking about rates before we, got to New York. And when I went on CNBC at, 2:00 in the morning, one of the things they asked me about, what do you think about the Fed and housing? And I said, the Feds probably in their own interest want to keep home sales depressed. So let's be mindful of that when they have their comments. And, if they let the bond market kind of get out of hand, even though they're very happy with where real yields are, that in a sense gives you kind of their mindset of the housing market. And I've said this all year long. When Neil Kashkari came on TV early in the year and said 6% mortgage rates is a problem for the Fed, that should have been a wake-up call for everyone. That home sales not crashing anymore like they did was viewed as a bad thing in the Federal Reserve's minds in fighting inflation, which I still haven't figured that out one yet because inflation doesn't flow with home prices. But in any case, when they asked about the lock-in effect with Jay Powell, he's like, we don't even think about it. That's not, and that's kind of the correct answer. If you're dealing with inflation and employment, the mortgage rate lockdown premise doesn't really come into play unless the job market is weaker. And of course, what happened the day after the Federal Reserve is jobless claims data came in very good, better than anyone expected. Now, some people say, well, the seasonality of it, and of course, we're going to have some seasonality perks in every jobless claims, but it's been going down for some time now. And so is continuing claims. So the one data line that I focused the whole year on has gotten noticeably better recently. And, even though job openings has fallen, the job growth rate, jobless claims is the main thing for the Federal Reserve and the bond market, because when claims break, that means the labor market broke. And I think one way I try to explain this, especially to my stock trader friends, let's say we were all in a coma and then, 20 years we wake up and somebody tells us, oh, by the way, jobless claims is under 300,000 for the last 12 months and job openings are over 8 million. Any person will go, oh my God, the labor market is hot. So look at it in that way. And with the claims data that came in today on top of everything else with the Fed, the bond market broke above that, 4.34% level that I've been focusing on, and it just shot up higher. Now, the one thing interesting so far today, so this is on Thursday that we're talking about, so Friday or Monday morning might be completely different. The spreads aren't as bad as it used to be. So mortgage rates haven't actually gotten to the yearly high yet. I think the last print is 7.47, at least the one I'm tracking. And we're talking about just a very small basis points under. Spreads aren't as bad as it used to be. If they were as bad, we're 7.85 around there on the national averages. So that happened this week. And again, jobless claims are low. Even though the jobs data is not as tight, the Federal Reserve did not make any kind of effort to kind of make sure the bond yields behave right. And, as always, housing is not their thing. So they have no problem making that the sacrificial lamb. And I think part of the maybe more positive takes the Fed has had on housing is cover for letting the long bond yields go up higher and mortgage rates higher, because the short-term rate hike story is pretty much done. Even if they have one more, that's pretty much over with. But the long end of the market, or the 10-year yield or 30-year yields, them rising right now, usually that's kind of what happens toward the end of an expansion. The inverted yield curve steepens, and we haven't had that happen yet. So it's a lot to take in a week. Very interesting week, but that's where we're at. And again, jobless claims are good. Jobless claims have been trending good for some time. Job openings are still over 8 million. So the labor market is not as tight, but it's not broken, and that's the key. And a few months ago we talked about what does it mean if if the labor market still stays good and the economy expanding, or a soft landing. Rates could stay higher for longer, but this one gets more interesting for the Fed because real yields are restrictive right now. What do they do going out in the future? And staying consistent with my theme, the Fed will not pivot until the labor market breaks. The labor market is not broke, so here we are today dealing with this.
I mean, it feels like if you're in the mortgage industry, you cannot get a break. You can't catch a break because you're thinking, great, the Fed decided not to raise rates. That should be good news. I should be looking at rates going lower, and the opposite happened. That doesn't make sense to most people.
Yeah, whenever you're at a key technical level and the wording is very hawkish, that'll break. And we've had some abnormal bond yield events recently in the last 7 days. So it's getting a very itchy finger out there for bond traders. And we saw that this week. But again, the Fed, this is just my take. The Fed won't pivot until jobless claims break. And I have that 323,000 number, and we're close to 200,000. So we are far from that. And the bond market took us up. But the question now is, with the Fed saying that we are, restrictive right now, how much will bond yields need to go for them to start to maybe intervene in the conversation and saying, we don't want this to continue?
Sorry, I'm making a timestamp note. So hold on. So they can take that clip for social. 6. Okay. Okay, well, so we talked about rates. Let's talk about some other things that are going on. Existing home sales.
Existing home sales, interesting, because the year-over-year price growth is picking up now. I'm not a big fan of median sales prices. I just think it's not the most effective way for pricing. And the lower end homes are obviously acting better. And if it was the higher end homes, you can make a case that existing home prices may be a little bit inflated because of that. But that's not the case here. It's just the lower price markets are doing well across the country. Here we are today. Existing home sales are near 4 million. We haven't broken under 4 million yet, and home prices are still rising. And I think again, for all my work, especially in years 2020 to 2020, we're trying to emphasize this is a supply story. This is not record-breaking demand. This is not like the housing bubble years. And it's hard for me to get certain people convinced because they say, well, as soon as home sales go down, prices are going to crash. We just had the biggest home sale crash ever recorded in history. It is almost October, and the year-over-year data is showing actually acceleration in prices. That's more or less because the comps are really easy. That's one of the things I emphasized in the article, that, take the year-over-year comps with a little bit of grain of salt, not just for home sales, but for prices as well, because last year was historic. Guys, I cannot stress enough how historic the last kind of 6 months of 2022 was. When we talked on November 9th, when I wrote, it says, it really seems like home sales want to go to 4 million. And, back then we were actually near 5 million too. It wasn't like, we were getting there. And it's just like how the forward-looking purchase apps were acting. 4 million is that level. And if you look where Purchase Apps is right now, and you look at when the last time we had 4 million during COVID, where we are now, we're kind of, we're there. And we can't grow sales, and rates are going up higher. So it's the question is, eventually higher rates, creating more inventory, more supply, price cut percentages should grow. It's been a struggle in this sense because, again, even with the NAR data, negative inventory year over year with some time now. So that's the only way I could explain why home prices are at all-time highs and we're seeing a little bit of acceleration. It's just because active inventory is low and home sales still have not been able to break under that key 4 million level. I've always been, that 4 million level has been kind of a line in the sand post 1996. And to break that, we did it a little bit over in 2008 for a few months. We had the home buyer tax credit that took us underneath there. That was more of a fiasco event. So here the question is, can we get below 4 million? Yes, we can. Rates are high enough, affordability is bad enough, and new listings data, even though it's, I'm talking about we should get some flat to positive prints year over year, it's still historically low. So we can send home sales under 4 million. The last 2 weeks purchase application data was positive week to week, but that was before the big increase in rates and bond yields, and we'll see how that impacts the future. So it's one of those crazy years that if you're not actually a housing data person, like a real one, not a kind of a doom crazy person, it might be very confusing to see the data that we saw in the existing home sales report. So the article is really trying to frame it in a way for it to make sense. That we have such a historic event between what happened from 2000 to 2012 in this country, from 2013 to 2023 in terms of all the housing data. It is such a historical difference, especially with supply, that trying to get people to focus on active inventory being low, new listings being low, matters in terms of pricing. And that's why, the tracker's created. That's why we track weekly forward-looking data to give people an idea, because I guarantee you, if I had said in September, the 10-year yield is at 4.45%, mortgage rates are above 7%, have been over 7%, everyone would have said, oh, home prices are down 12, 15%. Oh, wait a second, they did say that, even though it's not knowing where rates are. And we're here at all-time highs because I think there's people who are just, I can just see this, they're not trained housing analysts. It just looks like to me they're making stuff up. They're just like taking a percentage and just throwing it up. And the weekly tracker is designed to teach people how to do that, because there's such a difference between last year and this year, even on the tracking basis. So it gives people an idea to think about in the future. Because when it breaks, well, it'll show you, and when it starts to recover, it'll show you there as well.
So speaking of starts to recover, I really feel like, I know you are not a fan of the whole idea that there are buyers who are being sidelined, but I think that this year, when you look at how high home prices are, how high rates have been, you have to think that just the normal demand that you have for housing has been put off, and that there is some pent up demand here if rates came down.
I usually hate the pent-up demand thesis.
I know.
I think it's more of a marketing line. And but in this case, because we had such a historic housing inflation event, that there were buyers who literally said, I know I can't do this. I need rates to get to this level, or I need, my total payment level to get to this level. And remember, your total payment level doesn't necessarily revolve around prices, rates. You get a bigger down payment, your wages rise. There are other variable factors that go into that. So because we had the biggest home sale crash ever, that even just an extra 500,000 home buyers makes a variable change into the data line. So in that context, I would agree, because we saw what happened last November, December, and January. That mortgage rates went from 7.375 to 5.99%. It facilitated one of the biggest month-to-month sales reports ever in history. So that is there, but rates didn't break under 6% with any meaningful fashion. Of course, it's under 6% for some builders. And then after that, rates have been slowly rising up. And so we haven't had any kind of traction with lower rates. But Man, Sarah, it is. I can't imagine how so many people must be lost this year if you're not reading HousingWire or following me on social media to not understand why aren't home prices down 20 to 30% when home sales are pretty much where they were during the worst levels of the housing bubble crash, and we're still having effective year-over-year price growth this late in the year. And again, it's just credit channels run inventory channels. Credit profiles are good. Homeowners are doing good. Active inventory is historically low. We haven't seen stress in the data yet, and we didn't see stress really last year either. New listings data had a few weeks that show year-over-year growth, but nothing like big in a meaningful way. I'm always worried about the rubber band effect, here. If this goes another year and you have now, let's say, 2.7 million home buyers waiting, when you're working from such low level in sales, it can create a little burst in demand when rates fall. And then again, if we're still here with this low of inventory, it becomes problematic again. And this is the whole premise, the whole concept of the savagely unhealthy housing market really started at the end of the summer of 2020. Like, okay, this is not a good place to be in. It's because of what we're dealing with right here, right? This buyer and seller struggle and the affordability issues, and sellers are buyers and sellers are, hey, I can't afford it. Doesn't really make sense for me. And what goes on in this market. And even with all that, we're still going to have near 5 million total home sales this year.
So let's talk about inventory because, we talked about last week, we've changed the tracker a little bit. It's just coming out earlier. You're getting this amazing data from Altos Research. And so you can, before anybody except those people at Altos, what exactly is happening. So what do you expect this weekend?
I'm hoping my heart doesn't get broken. I've been waiting for 11 to 17,000 weekly active listings number. I expected with higher rates, the inventory growth can pick up, and it hasn't to the fashion I want. But weakness in demand, days on market growing, should be able to grow the inventory a little bit faster. New listings data, I'm still, waiting for the second half of the year to get at least a flat to year over year print. That's another thing I talked about on CNBC is, I think we're forming a bottom here. And because we're forming a bottom, it doesn't really take much to move the needle. Even though it might be still near all-time lows, getting some positive year over year is good. We got to get a bottom in that data line. So I'm hoping that today and Monday, when people are hearing this, that I get 11 to 17,000 weekly active listings growth. Because again, more supply, more choices, which means that whenever rates do fall, let's just say it goes back down to 6.5%, nothing dramatic. There's more choices for people, right? And that's after all the housing inflation we've seen since 2020. That to me is such a key data line. And growth in inventory to me is a positive. I'm a very pro supply person, but I have not gotten what I wanted this year, and rates have been higher. The slope of the inventory curve is very slow, kind of normal in a normal marketplace. And to me, again, it's part of this is home sales aren't really crashing or going negative in a very big way. We just had one big positive print. We're just pretty much just hanging around here at 4 million. And that has not facilitated the inventory growth that I thought. So we get a few more of these. And what I'm hoping doesn't happen this Monday is that the new listings data takes a dive because of rates. That's the one thing I've been mindful of and keeping an eye of. And so far, I have not seen anything to that nature. We've had some volatility in data. And we got to start setting up for the spring of 2024. And again, to me, the spring of 2024 is going to be such a big event because we might have for the first time a very normal spring inventory season and not have the 3 abnormal events like we had in the last 3 years. And I think that'll be critical. And the closer we get to the end of the year, we'll focus more on that.
Hopefully this, 2024 spring will actually see a lot more growth when we normally would. I mean, this year for a good part of the year, I think we were in July, and January still had the most active listings over July, which is crazy.
Yeah, what's been abnormal lately is that usually January inventory, the bottom is set. In January and February, the single active listings grows. We've got that seasonal slope. And then we have the seasonal decline. What's occurred lately is that we have a very late start to the year. So it's like April 14th was the seasonal bottom. That's like the longest time ever in history. And then we have a very slow curve, and then the seasonality impacts us. Now, inventory is going to have a little bit more of a seasonal increase longer, but we always hit that seasonal bottom. And here is just, I'm hoping that we just have a year where January, February is the bottom and we rise, and we're not like April, March, June, where, we haven't even risen above the lows we saw in January. That again, that's not a normal functioning market. That's not something we traditionally see. But part of it is active listings are low. Part of it, if you get just a little bit of demand curve higher, it takes homes out of the market. So I've always stressed, what people sometimes forget is, of course, sellers or buyers and lower mortgage rates, you get more transaction. But if a first-time home buyer, which finances 90% or plus, they're not giving you a house. They're just, bidding for what's out there. So the bigger mortgage buyer actually impacts the inventory curve more. So that's why when lower rates happen, inventory doesn't grow. The mortgage rate lockdown is not a thing in terms of creating active listings. You could create more demand, but it also facilitates the one buyer profile that does not need or does not give you a piece of shelter for it. And that's why if you look at this inventory data for many years, it's been slowly moving higher. Guess what? The millennials have been slowly buying up more and more homes. Voila, 2020 to 2024 comes. The last 3 years have been just so abnormal that I'm just hoping that we just get a normal year in 2024.
We will be fighting about the mortgage rate lockdown, really debating at HousingWire Annual. That is coming up. So listeners, if you are not signed up yet, if you're not registered, you should join us. It's October 10th through 12th in Austin. Logan is going to kick it off with a great talk about the housing market. And then he and I are going to end it with a live podcast. And we are going to include audience members. It's going to be a lot of fun. And I'm finally taking him on in this debate. So join us there. And in the meantime, we will continue to do this. And Logan, thank you so much.
Pleasure is all mine, Sarah.